What most people call financial pressure is often blamed on taxes, inflation, or income level, but there is a quieter force operating underneath all of it, something less visible yet far more persistent, a kind of silent tax that does not appear on any statement yet steadily shapes how money moves through your life. It does not come from the government, it is not deducted automatically, and yet it can take just as much, sometimes more, over the course of years without ever being noticed directly. Imagine two individuals earning the same income, living in similar environments, facing identical tax rates and cost of living, yet one consistently feels constrained, always calculating, always postponing decisions, while the other experiences a sense of flexibility, even without dramatically higher earnings. The difference is not luck, nor is it purely discipline. It is the structure of their financial system, specifically how invisible costs accumulate through behavior and timing. This silent tax begins with friction, the small inefficiencies in how money is used, delayed, or allocated. Every time a decision is postponed, every time a bill is paid late, every time a cheaper long-term option is replaced by a more convenient short-term one, a tiny percentage is lost. Not enough to trigger concern in isolation, but enough to compound over time into something substantial. These are not dramatic financial mistakes. They are ordinary decisions made under time pressure, mental fatigue, or uncertainty. Psychologically, this happens because the brain is not optimized for long-term compounding. It is optimized for immediate clarity and reduced stress. Choosing the easiest option often feels rational in the moment because it reduces cognitive load, but over time it introduces a pattern where convenience quietly overrides efficiency. The result is a consistent leakage of value, not through large visible losses, but through repeated micro-decisions that each carry a small, hidden cost. To understand the scale of this, consider a simple structure. If a person loses even 2 to 3% of their financial efficiency each year through these friction points, whether through late fees, suboptimal purchases, missed discounts, or delayed investments, the long-term effect is not linear. Over 10 or 20 years, this behaves more like a compounding drain, where each year's inefficiency reduces the base from which future growth could occur. In practical terms, this means that two individuals earning the same salary and saving the same nominal amount can end up in very different financial positions, not because one took extreme risks or made extraordinary gains, but because one avoided the silent tax more effectively. The gap is created not by what is earned, but by what quietly disappears along the way. When you zoom out to a systemic level, this pattern becomes even more significant. Entire economic structures are built around convenience, subscription models, financing options, and time-saving services, all of which are valuable in isolation, but collectively increase the number of small decisions where efficiency can be traded for ease. The system does not force these choices, but it presents them in ways that make the higher cost option feel normal, even invisible. Over time, this creates a behavioral baseline where spending slightly more for convenience becomes the default rather than the exception. The silent tax is not a single event. It is a pattern, a rhythm of decisions that slowly shifts your financial trajectory without any single moment standing out as the cause. What makes this particularly powerful is that it rarely feels like a mistake. There is no clear signal, no immediate consequence, and no external pressure to correct it. Instead, it blends into daily life, becoming part of how you operate, which is why it persists for so long without being addressed. The shift begins when you stop viewing financial progress purely in terms of income or savings rates and start examining the efficiency of your system, not in a perfectionist sense, but in a structural sense, where you reduce friction, automate where possible, and create environments where the efficient choice becomes the easy choice rather than the difficult one. This is not about eliminating convenience or optimizing every decision. It's about recognizing that small inefficiencies are not neutral. They accumulate. And once you begin to see them as a form of silent taxation, something that continuously takes a percentage of your financial potential, your focus naturally shifts from chasing more to losing less. In the end, the most significant financial changes often do not come from dramatic increases in income or sudden opportunities, but from removing the quiet drains that have been there all along. Because when those disappear, what remains is not just more money, but a system that allows it to stay and grow with far less resistance.